Welcome, everybody, to the Thursday edition of the Not Your Average Investor Show. Today, we're going to look at a property that is brand new construction, will receive $1,300 a month in rental income, and will have a 2 or 3 year lease signed and deliver a 7.5% estimated ROI. Yeah. And here we are persevering, and we are officially live on Facebook for the Thursday edition of the Not Your Average Investor Show, what we love to call the JWB Rental Property of the Week. I am your host, Pablo Gonzalez. With me, as always, the man that I affectionately refer to as GC, because he generates cash flows, because he's got genius concepts, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
Before I forget today, I'm just going to go ahead and tell everybody to go to jwbinventory.com because I always forget this. And you can download the property that we are going to be tinkering with today. You can download the sheet, the evaluation. It's a fully interactive worksheet that you can use to analyze all of your deals. I suggest that you go there right now and start downloading that sheet, because if you want to know about rental income properties and hold rental income properties in your portfolio, you're in the right place. If you want to know about the best property management service for real estate investors in Jacksonville, you're in the right place. And if you're a real estate professional looking for an edge in the Jacksonville market and maybe a couple of extra opportunities for you and your clients, you're in the right place. Next place to go after that is chatwithjwb.com. Hop on with the team, and it'll be a very, very value add scenario for you where we figure out what you need and point you in the right direction. And right now it is time for, you know what it is, right? What time is it, Greg?
It's game time. It's roll call time.
It's the roll call. Lee Bishop, good afternoon, friends. John Hannon, good afternoon, all. Leo, good morning from California. Raul Tirado, welcome back. Raul, hello, everybody. Drew Barnhill from Atlanta. Hello, Drew, good afternoon. And we got a short roll call today. Huh? We only got 15 on the call, but I have a feeling that our friends are going to be joining us later.
It was a short roll call, but it was an effective one. Lee's telling me that I'm looking a little orange here today. There we go. I don't know what it is, but apparently that's the color I'm giving off today.
Orange, you glad Lee's on the call to give you some good constructive feedback. Right? So as you all know, this is a community show. It is driven specifically on Thursdays, right? Especially by you, your comments, your questions and answers. So there's two ways to interact. Saori is here from San Diego. Welcome back, Saori. Good to have you back. And there's two ways to interact with the show. One is the chat that's already blowing up, and we already have people chiming in. There's a little trick there, right? Like now they actually changed it. It used to be panelists and attendees, and then you had to change it to everybody. Now it shows up in default as host and panelist. You're only talking to me and Greg, me and GC. And if you change it to everyone, now everybody sees what you're doing. So just double check that when you're chatting, everyone can see what you're doing so you can make a new friend and benefit from the wisdom of the crowd. And second is, if you want a Q&A, you want us to dive deep into something about this property or something about what GC is sharing with you, pop open that Q&A, put it in there, and that stays in front of me on the screen. I get to not mess it up for you, right? It makes it a lot easier. Alejandro Lopez, my primo from Northern California. Good to have you, Alejandro, on the show. And GC, I just found out that we got some breaking news today in the housing industry, isn't there?
I love it when you do that, by the way. Just put a smile on my face every time. We've had a lot of breaking news the last few episodes too. It's been great. Yeah. So I thought I would bring everybody up to speed with the state of things in all things eviction moratorium. So it's interesting. So I prepare for these shows usually about maybe a week before the show or maybe 3 days before the show. I was actually preparing for this one, and I write out my talking points. I write out what I think maybe become what is it again? A breaking news. How does that go again, Pablo? Yeah, whatever that might become. It starts with a note to myself. And so I was prepared to let everybody know that the eviction moratorium had passed and was not renewed. And the eviction moratorium previously was in place due to the CDC, and that was scheduled to end on July 31st. It did. And that's what my note said. And I was preparing everybody for what the next step would be. Well, I was in my meeting with my business partners yesterday and read the news. And what do you know? The Biden administration extended the eviction moratorium for 60 days for different parts of the country. And Jacksonville is one of those parts of the country that the eviction moratorium is extended for 60 days. Now, I'll share with you, if you're if you're like most rental property investors out here, you have more questions than answers when it comes to what this eviction moratorium is. What does it mean? It means different things in different parts of the country. So I wanted to share with everybody what it really means here in Jacksonville, what this new extension of 60 days will mean for you if you're a JWB client who happens to be affected. I also have some numbers for the number of clients that are affected by this too. So there we go. This moratorium, what this means here in Duval County is that there's no change for what can be done for evictions as of probably the last maybe 6 months, maybe 9 months. At that time, Duval County allowed us to start the eviction process with any resident who had now what they said is if a resident filled out a form called a CDC attestation form, and if a resident said that they had been negatively impacted by COVID-19, then you can start the eviction process, which is important for you. You want to start the process if that's the right thing to do for you and for your investment. What that moratorium said, though, is that you cannot finish it. You can get all the way to the finish line, and then the writ of possession will not be allowed to be handed down, which in effect means that you cannot actually evict. However, many people don't know that you actually can go through all the steps of the process. And so for many, many months now, that has been the case with JWB. This is a positive thing to be able to go through all of those steps because there's a lot of positive outcomes that can come from that. And the least of which would be that when the moratorium is over, you are ready to, of course, serve the writ of possession. So no change whatsoever by this 60-day extension. It's business as normal from what we have understood. Now, because we could start that eviction process, that was something that we used to be able to have that conversation with residents that this affected, that, listen, this is going to happen. Let's come up with a solution so that we can keep you in your homes, so that we can do right by our property owners and that everybody can win here. And the easiest and the best part of that is the solution for that is what's called a stipulation agreement. So a stipulation agreement is something that's a tool that we've used extensively to be able to maximize people staying in their homes and collecting rent. And what that is, it's a payment plan. It's a court approved payment plan called a stipulation agreement. So that has continued to be in place. It is really effective. About 50% of stipulation agreements get paid off in full to the owner. And so that's a positive thing. So all in all, the 60-day extension now means that those residents who have not entered into a stipulation agreement and who have signed the CDC attestation have another 60 days before they can be served the final piece of the eviction process. And so if you're a client that has one of those cases, this would be another 60 days before we can complete the process and turn that into a performing asset for you.
Okay. Okay. When I hear of all of that stuff, Greg, it sounds like there's an uncertain future happening right now with COVID, right? Like let's just call a spade a spade. It feels like it's kind of coming back, right? Like whatever weirdness is starting to descend upon the land again. And the governmental leadership, the powers that be, they're taking actions that they're going to take based on however they feel needs to move forward, right? So there's a little bit of confusion as to what the future is. Can you talk a little bit about, for those of our friends that maybe weren't here when COVID broke out and thought that, all of a sudden there's a moratorium for the first time. Right now we've been underwater, but the lengths that JWB takes to avoid evictions and how it's not just about when somebody isn't paying that you just go straight into eviction, and why maybe evictions affect less the JWB property management properties than they do the average property management.
Yeah, I think that would be great to review. And I think the numbers will highlight this as well. So we started there with the brass tacks, right? That's what this moratorium means. It's 60 days. If you're affected and you have a resident who is non-paying and who has signed the CDC attestation, there's not much that I can do to turn that into a performing asset for another 60 days. And that's not a message that I like to deliver, but that's the reality. Our hands are in effect tied there. However, there are a lot of things that we do to avoid that situation. I wanted to give you numbers on just how many clients are affected by this at the moment. And then we'll talk about how we do this. So we manage a little bit over 4,100 homes here at JWB. 4,100 homes under property management with us. There are a total of 23 residents that fall into that of non-payment, sign the CDC attestation, and that in effect, our hands are tied and we cannot move those people out. 23 out of 4,100. So now I feel for, there are clients I'm sure that are on the call right now that are affected, and I feel for you. There have been times when I have had non-payment of rent many times as an owner of rental properties. It's not fun. But if you think about risk overall in this asset class, or as far as JWB's property management, the risk is relatively low that you fall into one of those categories. Again, 23 out of 4,100. I don't have the math in front of me, but it's really low.
It's 0.05%.
There you go. 0.05. I'll take that, right? I'll take that. We would assume that the 60 days, I mean, this one surprised all of us that this was another extension. So it's been a long haul for those clients that have been affected. It's a little bit longer of a haul, and we hope that will come to an end. Overall, I wanted to look at what the rental collection was and the impact of that moratorium on rent collection. Generally speaking, our average rent collection all of last year was 98% during COVID times. I just checked for the last month. In July, our rent collection was 97.5%. Now, as this moratorium goes on and on and on, your rent collection numbers, even if you're performing at the same level, your rent collection numbers should go down, because every month that's possible rent you could collect and you're not able to collect it. The burden grows. So if you run those numbers, 23 residents that fall into that bucket, that's about 0.5% of rent collection due to this eviction moratorium that we're just simply not able to collect. And so you put the numbers together, 97.5% rent collection every single month. That's really good. There's about 0.5% on top of that probably we would collect if we didn't have this eviction moratorium, and you get to around 98%. So if you just look at those numbers and you think about this asset class, people come here for consistency outside of COVID times, outside of an eviction moratorium. To collect 97.5% rent in an eviction moratorium that's been going on for, a year and a half-ish is really, really consistent. And then you throw that, what was that? 0.05% is the rate of clients that are affected at this moment from an eviction moratorium in terms of non-payment and not being able to evict. Those numbers should scream a consistent asset class for you, because they're really, really strong.
There you go. And I think it speaks a lot to the idea that JWB as a property man, as a company in general, you really go hard on like long-term relationships, right? So these are all numbers that are coming on the back of proactive communication with residents, providing an environment for living that is better than everybody else's anyways, right? So anybody that's going to go into one of these like eviction things, it's really the last straw, because right now they had it pretty good, and they're not going to go into eviction just for the heck of it, because at the end of the day, they're not going to find another property that's as good for the same price. They're not going to have the same relationship with a property manager. Your team goes above and beyond to just like actually have a relationship as opposed to be a check collector, right? Like, I mean, that's something.
Yeah. I mean, most property management companies, if somebody doesn't pay rent, and if you think about how that property management company makes money, it doesn't cost them any money when an eviction happens. And if they evict somebody, unfortunately for you, they can evict that person, and then they can put a new resident in. And you know what they get to charge when they put a new resident in, Pablo?
Placement fees,
which are much higher than monthly rents, monthly management fees, and much higher than renewal fees. So, if you're just thinking about following the money, most property management companies are not incentivized to go to the nth degree to keep a resident in your home and to figure out solutions. They don't do stipulation agreements. Very, very few property management companies take on that additional work to go ahead and get it approved by the courts and work out that relationship with that resident and manage it. I mean, it is a lot of work. We do that because we know the value of long-term leases and long-term resident stays. And ultimately, if we do a good job there, your return on investment is going to be higher. And ultimately, if we do a good job there, you're going to come back and buy more houses from us. And that's how we win. So, I just tell people to follow the money. If you want to see how behaviors are actually put into place and how companies are run, follow the money, see where they're incentivized. We're incentivized to keep residents in your home for a very long time. and most property management companies.
Yeah. There you go. All right. So we got Bill Shields checked in the chat late on the roll call, but he's patented Buenas tardes, damas y caballeros. Buenas tardes, Bill Shields to you as well. And I want to prompt everybody right now, before we go to the property of the week, that you go to jwbinventory.com, jwbinventory.com. I know I just mumbled that at 1,000 miles an hour. Download the spreadsheet so you can follow along as soon as we get to it. But as promised, when questions come, questions will be asked. Raul Tirado, who is joining us again. Raul, I feel like you're becoming a regular, man. I like it. He's got a question. Any future plans to expand outside the Jacksonville area?
Raul, welcome to the show. Thank you for being here week after week now. And that's a wonderful question. It is one that I have received quite often, and I can give you a very solid answer on this. The answer is no. And it's a very different answer than what turnkey rental property companies do. And I think it's the difference between a turnkey rental property company and a vertically integrated rental property provider like JWB is. A turnkey rental property company usually doesn't do the things they need to do to make sure that they have years and years of inventory for their clients. And they take this approach where they're going to, if they run out of inventory, they're just going to go to another market. And, we have always felt that there's a lot of risk that you bring to a client by thinking that you can just pick up shop here and go to another place and replicate it with the incredible network that it takes to produce these investments for you. So we've never been of that volition to go to market. The other thing about this is that we have this incredible opportunity to create better risk-adjusted returns for you as a client by going deeper and deeper into the Jacksonville, right? We can be very active, influential. We can be a part of a lot of change in aspects that no other turnkey company here in Jacksonville can do. And it's because we buy land sometimes a decade in advance. Right now, we're investing with our own money in buildings downtown Jacksonville because we know how important that is to increase the amount of people that are living downtown, increase the business community downtown, because we need to raise median incomes. It's not a problem today. It's a 10-year problem, 20-year problem, potentially for Jacksonville. We need to raise incomes and we need to start on it today. And our commitment to downtown Jacksonville is something that we're doing. Why is raising median incomes important to you? It's because ultimately prices are going up right now. Prices cannot continue to go up forever. As an investor, if you own rental properties, you want prices to go up, right? After you own it, of course. Well, you're going to get to a plateau. If median incomes don't rise, you're capped on what home prices will be able to rise to. In effect, your return on investment is capped, right? We can influence that here because we are committed to Jacksonville and Jacksonville only. So both of those things, we think being committed here in Jacksonville is a risk mitigating factor. It's just not easy to do what we do and think that you can go and do this in multiple markets. Many investors, many turnkey investment companies fail. And then there is just more of a massive opportunity to increase your returns on investment by being focused in one market. So that's why we're here. We have no plans to go anywhere else, and we're excited about it.
Well, Raul's got a follow-up question. If you're investing in buildings, do you plan to syndicate to investors on those buildings?
No, it's not the plan. And that's another different answer than most companies would give you, right? They do things today to sell it, right? That's not how we do things at JWB, right? We have part of our business is just focused on what's coming next. And we invest our own money in what's coming next. And that, opportunistic part of the company is what allows us to have opportunities to sell 3 years down the road or 5 years down the road or 10 years down the road. And I've seen that a number of times in what we have today, right? Today, we're going to talk about a brand new construction home. Well, 10 years ago, this opportunistic part of JWB was figuring out how we could build new construction homes and sell them as turnkey rental properties. And so sometimes those things turn into assets that can be sold. Sometimes they don't. And sometimes but the important thing is that we put our own money into it and we figure it out. And there's no plans for JWB to syndicate these downtown buildings. The win for everybody is that downtown continues to grow. And when downtown continues to grow, all boats rise with the tide, meaning that the neighborhoods that you're investing in, that I'm investing in turnkey rental properties, are all 5, 10, 15 minutes right around downtown Jacksonville. So that's the immediate win. We don't have any plans to syndicate, and, we may never. I don't know.
Yeah. And I think it's really interesting when you look at it from my perspective, and I love looking at JWB as a business model, right? Because I'm learning a lot from them, and I get to talk about them often. But it's this idea that it's kind of your R&D department, right? Like you guys have like a 5% of your overall activity, right? Like 95% of your activity is focused on this one thing, driving value out of rental income properties, and then you've got this like 5% contained laboratory of effort and capital where you're placing these bets that then lead to the future. And one of these ones that you've identified that is strategically going to benefit everybody is developing downtown Jacksonville, but you're not going to open up that profile of risk to other people because you have it contained. You don't want it to, in this COVID world, right? Like you're anything that happens, it doesn't bleed out into anything else, right?
Yeah,
That's cool.
it's risky. I was just reviewing the numbers on some of the downtown renovations. $18 million renovation for the first time that we're doing it. Anybody want to take part in that? I'm not going to bring that to you guys and ask you to invest your money because I don't know what I don't know yet. Be quite honest.
Yeah, I think it's really cool. All right, and before we get into the what we got here, we got some breaking news, some more breaking news. Greg, you said you had some new numbers that you just popped open earlier this morning that
Yeah.
that illuminated some things before we get into this property.
So with the help of my team, I've been trying to get real granular on these rent increases that we have been seeing in Jacksonville. I think the last breaking news that we did last time was just looking at our rent increases on a percentage basis. And that was based on when a property moved out and was re-rented. And we had an 8% increase in rents just from the move out to the re-rent. And I was like, man, that's really high, right? To put it in perspective, in a normal market, you would expect rents to go up maybe 3%, maybe 4%. Usually it's a hedge against inflation, usually somewhere around there. So 8% from the move out to the move in is really high, consistent with significant growth in the Jacksonville market and other markets where population is growing tremendously. So I wanted to dig a little bit deeper. So my team put together a little bit different metric, but I think it's really pertinent, especially for the property of the week that we're going to look at here. We looked at the folks that purchased homes based on an evaluation, right? Everybody buys based on an evaluation. So for the folks just like you all who are watching the show that purchase a JWB property, from what's on the evaluation for your expected rent, what actually was the rent when they were moved in? And so this is like real time, direct, real pertinent to what we're talking about here, because we're talking about a property that is available and that will be sold to a client to, in the near future. And this is probably what's going to happen for those folks. So get this. So the last 60 days, hundreds of move-ins now, we went back and looked at the original evaluation. The actual rent was 11.6% higher than what was on the evaluation. Really big deal right there. Because when you think about return on investment, cash flow, the easiest way to jump that up on an eval is to increase your rents by 11.6%. Now, there's two reasons for this. One reason is the market is going way up for rents. We know this because there's a limited supply of housing on both rental properties and for sale properties. That is definitely happening. And another reason for this is because of JWB's core values. One of our core values is to underpromise and overdeliver. And as I've said many times in our evaluations, you're going to be able to look at the number on the evaluation and say, Greg, shouldn't that be a better number? Shouldn't that be higher? Right? Look at your interest rate that you're projecting there. Shouldn't that be lower? Wouldn't that help you present a better return on investment? And my answer is always, yeah, right? I could maximize every part of this evaluation and show you the very best potential outlook on your rental property asset. And we do that routinely, but we choose not to because I want to underpromise and overdeliver for you because I know it usually doesn't go that way in rental properties. Every other turnkey provider that I know of puts their best foot forward, the max they could possibly do, and then they trip a couple times, and then the investor at the end of the day is left feeling like they did not have an amazing experience. I want an amazing experience for you. So this is one example, 11.6% real time, just the last 60 days for what properties have had on the evaluation from what actually happened.
11.6% is a significant figure, man. Right? Like I gotta ask, did you see something like that coming? Like, were you guys kind of like holding an ace in the pocket, thinking, "Yeah, we're gonna show people like 3% extra, 4% extra"? but it just happened to pop out at 11%. Like, what outside of, I know you tactically under promise and over deliver. You've explained this to me multiple times of how you see this on every interaction, right? Like not just the property eval, but just like any time that you are promising something that you know that you can deliver for sure, but you're probably going to do better than that. You're just setting up for a good client experience that's then going to lead to better things, and the next experience is better, and you've created this flywheel of under promising and over deliver. But at an 11.6%, like talk to me a little bit about that figure and how that's created. That's just so like the bigness of it is just kind of shocking.
Yeah,
This is
it shocked me. It absolutely shocked me. We don't plan this much of an under promise and over deliver type of experience, right? This is just a reality of the rental market. The rents are absolutely exploding. They are going up at a rate that we have never seen in such a short time period. And really, this started to happen a few months ago. We just noticed it even more than we did in the previous 6 months. We noticed it in the last 3 months, and it's the same reason that you're seeing home prices go up so much. It comes back to supply and demand. It comes back to months of inventory. Well, there's months of inventory for home prices, meaning the sales. You can look at months of inventory, but we have never had this little inventory for homes that are for rent. And we manage more homes today than we ever had. I mean, to put it in perspective, we typically have right now about 30 homes that are on the market that are available for rent, and we rent 25, 30 a week as well. So there's like 1 week of inventory in JWB for available homes for rent. So when you have that, the market is working in your favor where you can increase rents. And that's what we do. And it's a wonderful thing for rental property owners out there, and for residents as well, right? We're not the only ones. This is being market driven. We look at other rental comps in the area, right? So this is the market. This is not JWB taking advantage of a resident. This is what's out there. And JWB, of course, can get a premium because of the quality of our work, like you mentioned, and the quality of our relationship.
amazing, man. So Laura McElroy, Laura, you've been coming around often. It's good to have you be a regular here. Happy to have you be part of the family. She's asking, which property are we talking about? Is this a specific property GC, or is this like across the portfolio?
Well, I looked up a specific property. So I'll tell you just the numbers on this. And the 11% figure, 11.6% is across all move-ins over the last 60 days. So that's a more general number there. But I pulled the most recent example. This is 8529 Cheryl Ann. And I'm sure, and Pablo and I were talking about this. I'll show this actual example in an upcoming show so we can break it down. But just to share the numbers with you, 8529 Cheryl Ann was purchased by a client. The home moved in the last 60 days. If you go and you look at that expected rent on that evaluation, it was $1,275. That's what that client bought the property expecting. The actual rent for that property is $1,536. It's a $261 increase in rent day one when that client owns that home. That over time should continue to go up as well. I mean, that's huge. $261 is more than the expected cash flow on that home.
Yeah.
You know,
Yeah.
so that's a 20% increase in the rent amount just on that home. And there's many other examples just like that.
Amazing. And then Lee Bishop has a question. Greg, do you see this happening on all properties that have a turn this year and early next year?
Yeah, I think it's a great time to be a rental property investor. I do.
That's really cool. That's really cool. All right. Well, we've gone along a long time here with breaking news and good news and medium news and answering questions. I want to welcome Nadeem, who just showed up. Nadeem, welcome to the show, my friend. He's a little late, but happy to have him. And now we are going to magically whisk everybody away, including Nadeem, to 1176 Angola Drive, Jacksonville, Florida, 32205. It is a purchase price of $210,000, 3-bedroom, 2-bathroom home, 2-car garage, estimated rent range between $1,275 and $1,325. Really, the lease being expected for 2 or 3 years of $1,300. And what the JWB investor comes for, right? What you're actually purchasing is not just this beautiful looking new construction home. You're purchasing this cash flow and this ROI And the estimated conventional financing total monthly cash flow is $118. And the estimated conventional financing total ROI is 7.49%. GC, let's talk through our usual, the total monthly cash flow. What does that include?
I'm happy to do that, but we have some awesome folks on the show that are, yeah, they're telling us that it's blurry. So let's do that little magic
All
trick
right.
that you do where you zoom in
All right.
there, Pablo.
How we looking now? How we looking now?
It's looking still a little blurry to me, to be quite honest. Yeah, I think going a little bit more, just focus on the return on investment purchase method. Yeah, I think the stronger you go there, it gets a little bit better there.
Is that better?
Uh,
How we doing?
I think we're doing well. Lee says that's great. We appreciate all the feedback. This is awesome. Thank you guys for all that feedback. It's better. So good. So cash flow. Let's start there, right? When you're investing in rental properties, there's two metrics that I want you to pay attention to. And the first one is positive cash flow. Positive cash flow means what you're left over with on a monthly basis from the rents that come in minus the expenses that happen on a normal monthly basis there. And this is really critical because at the core of this, this is what makes this an asset on a monthly basis and not a liability. I have a very simplistic view of assets and liabilities. I adopted this simplistic view when I read Rich Dad, Poor Dad, which is an asset is something that pays you every single month. A liability is something that you pay every single month. And when it comes to rental properties, you want assets, right? If you go into liabilities and you start going negative cash flow, then you're just banking on home price appreciation and speculation. And that's where people get in trouble. So the first and most important metric to talk about is this going to be an asset every single month? Is this going to pay for itself every single month? Because that is risk mitigation 101. And that is something that this asset class offers that you don't get in other asset classes typically. Positive cash flow, including the expenses. And the other reason why that's important is because if you're in rental properties, if you're taking your time here on a Thursday and spending an hour with us, which we super appreciate, usually that means that you are very vested in this asset class and you want this to be a significant part of your portfolio. And what that means is that you're probably going to need more than one property in your portfolio to accomplish your goals. If you start going negative, if you have negative cash flow of $100, $200 a month, that adds up to thousands a year. And then if you multiply that times 5 or 10 properties a month in your portfolio, now you're getting into a real liability. Now you're getting into thousands and thousands of dollars potentially every single month or every year that now you're having to pay every single month. You don't want to do that. So the first and most important threshold is this going to be an asset? And the way you determine that is on a normal monthly basis. Is this going to pay for itself? And so when you see $118 there, that's what that means. This pays for itself, right? This $118 is not going to change your life, right? People sometimes look at that and say, wow, that's kind of small. Why would I do that for $118 a month? Well, you're not doing it for $118 a month, right? That's just making sure that it's there. It can pay for itself. It sustains it. What you're really doing is you're buying that asset that pays for itself so you can profit from all 5 profit centers, not just the monthly cash flow.
There you go, GC. And the other thing that I kind of wised up to as you've evolved your messaging on this, which is why we do it every week, right? Because you get better and better at explaining this thing and you're explaining it in different ways. The scalability was one of the first, one of the new iterations of how this is scalable. I'm glad you mentioned Rich Dad Poor Dad. I feel like we mentioned another real estate book on Tuesday. So Rich Dad Poor Dad got really, really jealous. So I'm glad it's back in the mix. And the other thing that you've kind of wised me up to is this idea that you start at, because of the 5 profit centers, you start at 118, but at some point, if you're owning this property for the long term, it's going to go up to this 870 per month because you're going to have the debt being paid down. You're going to have appreciation. You're going to have all these different things. So this 118 is the scale point and it's a little bit of cash in your pocket. But at the end of the day, you're reverse engineering the portfolios based on what this looks like 25 years down the line when you've paid it all off. And that's really when you're investing for the long haul, what you're really going to end up getting in cash flow when you need the cash, right?
You're exactly right. There's a huge misconception out there about why to invest in rental properties. People think that you should do it just based on the cash flows. The reality for most people, you're never going to get to your passive income goal just for the monthly cash flow when you have the debt on it, I'll say that again. The reality for most investors out there is that you're never going to get to your monthly passive income goal just from the monthly cash flow when you have the debt on it. The way you get there is you buy and hold for a full market cycle, which is between 10 to 20 years. You build up the portfolio of assets to the right number. And then through all 5 profit centers, you're effectively able to pay down the debt so that you can own these free and clear. And then when you do that, that's where you get that, call it $870 a month in cash flow, which is what you see above there. That's when it's paid off. Eventually, you just buy and hold and you have a resident in there, this thing's going to be paid off. And the other cash flow or the other profit centers just help to amplify that effect.
Got it. So you talked about the other profit centers, right? So this 118 is like the typical month. This is your monthly cash flow, right? Like we say it 10 times, but that's what it is. That's your average month. 9 out of 10 times you're going to have that type of cash flow or more. But that's only one profit center. What are the other profit centers, and how do they tie into this 7.49% ROI?
Absolutely. So there are 5 profit centers. There's monthly cash flow, positive cash flow. We just talked about that. That's one. Then there is principal pay down. That's that beautiful thing we just hinted at, where you own this asset, your resident pays rent every single month. A portion of that rent goes to pay down the loan for you. And so that's the principal pay down component. Then there's the tax savings. You get better tax savings, better tax advantages for being in this asset class than you do in other investment asset classes. And it's available to everybody. Sometimes there's even super duper tax savings that are available just to a small percentage of real estate investors, but you don't have to be one of those real estate investors to get the normal tax savings. That normal tax savings make investing in the stock market pale in comparison. So we're talking about just those normal tax savings in rental property investing that is available to everybody on this call and everybody who invests. And so that's the third profit center, tax savings. Then there's home price appreciation. Talk about that, I would imagine, a little bit more here. Home price appreciation, if you understand how to evaluate this will be the biggest driver of your long-term return on investment. Doesn't mean that everybody can count on it, though. Long-term investment means that you invest for a full market cycle. And when you do that and you look back and you see all of the profit centers that we're laying out here, home price appreciation is going to be the biggest driver of your return on investment. Just have to know how to use it. And then the 5th one is inflation hedging, which is becoming a much bigger topic, especially over the last couple of months. And I love this topic because, inflation is something that many people don't understand. They don't really evaluate it. They don't think about it when they're thinking about where to put their money. Inflation is a killer of your dollars. You don't understand what's going on, right? The fact that over time your dollars become less valuable means that, you're fighting a battle against inflation in your investments. And there are certain investments you can invest with that fight that battle for you. And rental properties is one of those investments that fight that inflation battle for you, right? So what I mean is, in hard assets, rental properties are a hard asset, right? There's a house there. In hard assets, when inflation happens, generally speaking, rents go up along with the cost of goods and services around that hard asset. Home prices tend to go up along with the cost of goods and services around that asset. So you have a hedge against inflation. And that's really important, especially if you're thinking about holding an investment for a full market cycle, which is known to be between 10 to 20 years. So knowing all 5 of those profit centers, the next metric that I want you to pay attention to is that total return on investment. That's at 7.49% return. The way to think about this is, how hard is my money working for me? Now, this takes into account your net rental income, takes into account some of the profit centers. It takes into account tax savings and principal pay down. There's actually 2 profit centers as we look here now that it doesn't even include those. So it includes some of the profit centers. It also includes some of the additional costs that you're going to incur if you hold on to assets, rental property assets, for a long time. And so it takes into account some of the extra good things. It takes into account all of the bad things. And the bad things would be maintenance costs, vacancy costs, tenant placement fees, closing costs. It takes into account all of those negative items. It takes into account some of the positives, and that puts it over what your initial investment is. And that's meaning that your absent home price appreciation and not even taking into account inflation hedging, your money is working for you at about a 7.5% return on investment there.
There you go. So that is the holistic picture, not including the hedging against inflation, right? Which is really, really hard to quantify, but it's becoming a bigger deal now that we're clearly headed into inflationary times. And it doesn't include the appreciation rate, right? Because we have the appreciation rate here for 0%. Greg, before we get into the appreciation rate, I want to go back to the bitty beep beep bitty breaking news and talk about this rent, right? Are you already, based on what you just told us, is this already putting into account that 11% that you said would increase the cash flow, increase the return and all that stuff or not?
It's not.
Okay.
It's not.
All right. Then I think we should check that out. What was the increase then, Greg? I'll do it real quick on my calculator.
Yeah, it was 11.6%. So call it 11.
All right. So let's call it 11%. So we're going to go 1300 times 0.11 plus 1300. So that would put this rent, if it was to behave as they are behaving right now, at 14. And let me move it over. All right, 14.43. And that now, what does it do here? I don't know if it's still clear. Let me know if it's still clear in the chat.
Yeah, you're good.
And that increases the cash flow now to $247 a month and a 9.8% ROI. That's incredible.
Yeah. Yeah, it is. So here's the thing though. Now, this $1,300 a month rent is what you should expect for this home, right? You shouldn't go into this taking every evaluation that I put in front of you and say, well, you should just increase the rent by 11%. Right? That's not my plan here. My plan is to really kind of be more transparent with you and just show you behind the scenes, like this is what's actually happening. So this under promise and over deliver type of moment that we get to have. So I don't want people to come in and say, well, geez, you said 1,300. I really expect 1,443. But what I want the key takeaway to be is two things. Number one, there are a lot of ways for JWB to overperform when we put an asset in front of you. I know that if I tell you that you should expect this, and through the 10 or 15 different ways that we expect to do a little bit better, we're going to hit on some of those. And it's going to make you really happy as a client, right? What I've found is that it's not so much that you have to tell people that you're going to give them 8% returns or 10% returns or 12% returns, right? If you tell people that you're going to give them 7.5% returns and you can show up and you can hit 8%, you're going to make a lifelong fan, right? So this is just a little bit of transparency. This is what is really happening. And this is why clients come back to us over and over again and buy. It's because we are conservative with our estimates. You're going to find that all throughout our evaluations. The other thing to keep in mind though, is look how easy it is for any turnkey property company out there to just change one number and increase your rates of return by 2-3%, increase your cash flow by hundreds of dollars. And what normally happens is you're not going to find another company out there that is conservative on their rents. They're going to give you this 1443 probably plus $25. So it can easily go the other way, right? Look at the other way, right? Let's go back to 1,300.
All right.
There we go. Right. So let's look at this, right? If you're thinking about investing with another company, make sure you don't fall the other way around because most companies do this. They think they need to sell the absolute best thing they possibly can do at every single time. And we don't subscribe to that theory, but they do, right? If they tell you 1,300, I guarantee you that's what they're doing right now or probably a little bit better. So let's say that they come in at 1,250, right? You buy that property expecting a 7.5% return and it goes to 1,250 in rent. Well, boom, you just lost $50 in cash flow every single month and you just lost a point off of your returns, right? And then what we see on the phone sometimes, and this is one of the biggest reasons clients choose not to do business with JWB is they say, well, I can get an extra $25 a month in cash flow in this market, or I can get 9% return on investment in this market. And what I share with them is it is so easy for me to put an evaluation in front of you at 9% returns on investment, or it's so easy for me. I mean, I could do it just based on literally what we do every single day that it's so easy for anybody to manipulate the numbers. You want to be with a company that is way conservative because the other side of this is if you go too far down the line, and you miss your rent by $100 or $150 in the opposite direction, right? Now you're negative cash flow. That's a no-no. You don't want to do that. So
There you go. Greg, I mean, I gotta say, like we talk about this a lot. I've never really picked your brain on it, but it's gotta be tough to stay disciplined and not fudge the numbers here and there, and not even not call it fudge, but just like not keep up with what other people are doing and be able to compete and to lose clients to another market, to another provider, because you know that you're purposefully being conservative with the numbers. Like, how is that? How do you manage that? Like, how do you manage your team to not be like, come on, man, can't we just put the actual thing and like not really, I just not under promise, but just regular promise? Like, is that a normal conversation? How do you build that in, man?
I think that's a wonderful question, Pablo. Thank you for asking that, brother. My answer is it's not hard. It is not hard to see clients choose to invest in another company for an additional $25 a month or an additional 0.5% of return on investment. Because what my team is really bought into doing is to finding a good fit for us. And a good fit means a lot more than the return on investment. It means what do they value, right? We talk so much about how in rental property investing, there's a lot of different ways you can go about it. Many people focus solely on the property. They focus solely on what that property valuation is going to say. And they don't really pay attention to the team behind the investment. For our clients, it's the opposite. It's like you, Pablo, right? You focused on the team first, right? If you fall in love with the team like you have with JWB and you believe that we can manage your investment, if another team comes up to you, Pablo, and says, hey, I can get you $25 a month more in income, are you going to look at what they have to offer?
No, probably not.
So we just have this core belief that there is a good fit for us as a client. And that when we have that opportunity to work with that client, things are going to be wonderful. If we go through that process and they say, listen, I love everything about your team, but I think there's another team out there that can produce another $50 a month and they see differences in the type of team, meaning that they're going to settle for a lesser team, but can think that they're going to get $25 or $50 more a month. I think it's okay. I would encourage them to go somewhere else because that's not the way that we make decisions, right? We want to manage your money for the long haul. We want to manage your money for 10 years, for 20 years. You got to love the partner that you're working with. You got to believe in that partner. You got to want us to make very important decisions for you. And so if you value $25 a month more, $50 a month more on an expectation, on an evaluation, and that's more important to you than the strength of the team, then we're just not a good fit. And it's easy for us. That's what we believe in our culture.
Yeah, that makes a lot of sense, man. That actually, our buddy Andrew Smallwood that I introduced you to recently, I talked to him yesterday and I was asking him about how he niched down and specialized in what clients he serves and how to figure that out. And he's like, man, you gotta really fall in love with your client. You gotta fall in love with the people that you serve and then drive these was his words, a Grand Canyon sized gap between them and the competition. Right. Like, and then we started talking about like how you do that. And it's really what you're saying, right? Like, it's really the only way that in any kind of service industry or like product industry, where at the end of the day, things are commodities and you're just competing on product all day long. The way that you drive that Grand Canyon sized gap is the people, right? Like, it's the community that you build around, it's the team that you build. And it makes perfect sense to hear you say that now after a year and a half of working with you guys to understand that every single time I talk to you or Alex or either of the Adams, they're like, yeah, no, people buy our team and then they buy whatever else, right? Like, and you guys are just really, really into this idea that, the clients that you serve, the community that you serve, the type of person that you want to attract to you are the ones that value long-term relationships because that's the way you go about doing your business. And you do that by creating a moat that is better team than everybody else. And you like our people more than you like anything else. And therefore the service is going to be the best service, right?
Yeah, you're 100% right. And I think it even goes beyond that. If you're looking at the dollars and cents of it, I know that long term, it makes sense to be okay to let some people go if they don't make decisions the way that we make decisions, to let some people go and make that decision rather than us caving and changing our process, right? It's much better for us in the long run to let those people go. and only have the people that are clients of us, in our business, right? Later on down the line, if I have the right clients and we are a perfect fit, those clients are going to come back and they're going to buy more properties with us. And so we're going to win there. It's a lot less money to go out and have a repeat sale than it is to go out and generate new sales. So if you brought a whole lot of clients on board that didn't exactly jive with how you make decisions, your repeat sales would be very low. You'd have to put more time and money back into finding new clients out there. And there's a whole lot of other benefits for having such a strong repeat client base. So any way you slice it, if I was just looking at the numbers, it doesn't make sense for me to cave. It doesn't make sense for me to change what we've been doing. But that's only one reason. The other reason is because of what you just talked about, right? Like you got to fall in love. You got to fall in love. You got to believe what you believe and you got to fall in love with it. And you're going to attract others who feel the same way.
Makes sense, man. All right. So I want to go in and do the home appreciation example, but I've got a breaking news for you. Jen just joined us in the chat and she reached out to me last night and she's hosting the first ever Not Your Average Investor Show family gathering that has nothing to do with us doing it. They're actually getting together. Yeah, Jen, tell us in the chat, Jen. So they're getting together. I think it's her. I think Leo. I think one other person are getting together in Northern California. So Jen, why don't you put in the chat? I know it's happening tomorrow. Let everybody know the details. I'll say it out here on the air if anybody's watching. Meeting in Monterey tomorrow. Leo, Renee, Jackie, and her. Pretty cool.
Man, this is amazing. Jen, Renee, Jackie, Leo, thank you so much for sharing this with us. This is so cool. I think this is how a community builds, right? And Pablo, from the very moment I saw you started talking to me about you can bridge the online and the offline community. It can be this thing. And I'm like, dude, I don't believe it. I don't really believe it, And this is what you were talking about, brother. This is amazing. Thank you.
This is it, man. A year and a half in the making. It's happening. And Drew's bringing up a good point. We're probably going to do it in Jacksonville. We're getting together a group of us at some point in a couple of weeks as well. So if you're on Facebook right now, hit comment or hit like. If you're watching it, if you're in Northern California, you want to meet up with people that are clients of JWB, prospects of JWB, people that have been watching the show, part of the Not Your Average Investor Show family, drop a comment in there. The phone number to get in contact with Jen is 408-833-9868. She put it here in the chat and see if y'all get together. And I'm just super excited about it, man. Like this whole thing for me was, Gregg, we're going to drive great things for JWB. The number one outcome we want to create is community. So the fact that this is happening, this is not you and me putting out an invite for it, right? Like it happened completely organically. I think it's really, really cool. So I'm super, super pumped with you.
Yeah, I want to get the feedback. I want to see how it went for you guys because I'm sure there are others that would like to take this community and one step farther, and they have other folks in their neighborhood and they're an hour drive away or whatever it may be. So everybody who's getting together with Jen and Renee, if you wouldn't mind just sharing with us how it went and what model other people could follow if they wanted to do the same thing.
Yeah. Amen, brother. I agree. So, all right. So let's do our final magic trick here, Gregg. You talk about the 5 profit centers. We talk about how inflation hedging is really, really hard to put on paper, but appreciation really, really is, right? So this is at 0% appreciation rate. Talk us through first why it is that you don't put appreciation rate on the spreadsheet, and then we will show what it looks like if you comply with those standards.
Yeah. Well, there's really a few reasons here. The first reason is just piggybacking off of the conversation we just had, which is, why are we so disciplined about what we know we can hit? And why do we not put the pie in the sky numbers out there? It's because we like to underpromise and overdeliver, right? At the core of this is an asset that we're putting in front of the investor who's going to buy this, and it's going to produce a 7.5% return on investment. And we don't even have to talk about home price appreciation. Right? If you compare that investment alternative earning somewhere around 7-8% returns on investment, put that up against the stock market. Stock market generally earns between 7 to 9% over the long haul, but has a lot of volatility and does not have positive cash flow coming in. Right? So if you can put this asset, you don't even have to talk about home price appreciation, and you can earn the same returns that you can in the stock market, but you get monthly income coming in. This stands on its own 2 feet. So under promise and over deliver is how we're built. And we don't feel like we need to this investment stands on its own 2 feet compared to most investments out there, just even not given the including the home price appreciation. The other part of it though, and this is where most investors really fail, is they don't understand how to evaluate home price appreciation. If you look at the history and you go back to 2001 to 2006, the big run up in the market, if you talk to anybody who was in real estate and those who weren't in real estate, and you asked them if real estate always goes up in value no matter what, everybody said real estate always goes up in value. I know this because I started to buy it in 2006. And, at that time, I thought real estate went up in value as well because I didn't know what I know now. I was a young guy and just starting to learn this gig. Everybody thought real estate goes up in value. Now we all lived through the Great Recession. Home values went down over 35%. We realized that wasn't the case, 2008 to call it 2011. Coming out of the Great Recession, now the way most investors think is that I'm never going to count on home price appreciation. I can't count on it. It's speculative. And guess what? That's not the truth either. That's not what data shows us. The truth and the right way to evaluate home price appreciation is somewhere in between. And you've probably heard the term of a market cycle before. A market cycle means that home prices are cyclical, meaning that the average appreciation rate over time repeats itself or gets really darn close. And to put some numbers to it, in Jacksonville, if you look over the last 30 years and you took the average appreciation rate each year, it's actually 4.3% per year. And so the key, though, is that you have to invest for a full market cycle. That's that middle road, right? It's not that real estate values always go up in value every single year. And it's not that you can never count on home price appreciation. You can count on home price appreciation if you are invested for a full market cycle, which is known to be between 10 to 20 years. If you go back and you look at 10, 15, 20-year segments over time, you're going to see that average appreciation rate in your market is pretty darn close to the historical average home price appreciation for your market. So I don't know if you're going to listen to me. I don't know if you're going to invest for a full 10 to 20 years. So I put 0% right off the bat. I hope you listen to me though, because if you do and you hold on for a full market cycle, most likely you're going to experience appreciation each year, very similar to what the historical average is, which is 4.3%. So Pablo, you are teed up, brother. 4.3% in that appreciation rate.
I am 4.3%. Total monthly cash flow 118 and total ROI at 7.49%. And when you put in 4.3% appreciation, wabam, big jump of 16%. Cash flow stays the same, but the ROI jumps up 16%. GC, explain why.
This is the beauty of smart debt and leverage and using other people's money. This is all the same terminology. In real estate, you can take out debt. You can bring less of your money to the table to buy an asset. You can use somebody else's money for the remaining amount. And when you invest in an asset that goes up in value and you put less of your own money in the game, your returns can be supercharged. So here's an example, right? You've got a house. Let's just say you bought the house for $100,000, just to make it simple. That house goes up 4% that year. You earned $4,000 in return on investment from that appreciation. If you bought the house all cash, your return on investment is 4% from appreciation, because that's $4,000 divided by $100,000. All cash, that example, you earned 4% return on investment from home price appreciation. But if you use smart debt, you pay attention to this show, if you talk to my team, if you become aware of how this can help you in your financial future, your returns can be a lot better and you can still keep the risk down. That's the key. So in this case, same $100,000 property, it goes up in value 4% in that year. It's now worth $104,000 and you earned $4,000 of real return on investment from home price appreciation. However, you only put a fraction down. Let's say you put 25% down. If you run the numbers right now, put $4,000 in gain over $25,000 in your initial investment, because that's your down payment. 4,000 over 25,000 is actually a 16% return on investment just due to the home price appreciation. Same property bought with cash. It's a 4% return from home price appreciation. With financing, it's a 16% return on home price appreciation. And in essence, that's what you're seeing here. That's why the value for the return on investment went up roughly 16% when you're looking at a conventionally financed property.
The power of leverage, the magic trick that finally dawned on me about like 6-7 months into all of this thing, which really helped me to understand and explain to all my friends what this thing is all about. And then eventually made me invest as well. So really cool, man. I love pulling that trick. GC, I thought you did a really good job handling questions today. We had a bunch of breaking news. We had some great collaboration here from the family. We had 30 plus people with us for an hour. That's blows my mind every single Thursday and every single Tuesday when all these people, when all of our friends show up to hang out with us for a full hour of a work day. So tons and tons of fun. Next week, we have the client only JWB investor meeting on Monday. And then on Tuesday, we're going to show up and talk about what we shared on the client only meeting. So this is your opportunity to see what JWB clients see, to hear what they hear, to get that inside track on rental property investing, on Jacksonville, on the opportunities in the market, everything that they find out about. Come hang out with us on Tuesday. Should be a ton of fun. And like we said, if you're here to learn about rental property investing and have it in your portfolio, you were in the right place. If you're here to hear about property management, right, the way that JWB approaches it to minimize evictions and handle what's happening right now with a moratorium. If you want opportunities on the Jacksonville real estate market because you're a real estate professional and you want some insights and some extra opportunities that might lead for you and your clients. Hope you got value today. If you want some more value, you want to apply this to your specific situation, go to chatwithjwb.com, map out a call with our team. They'll get to know you and provide as much value as possible and see what the next step is for you from there. GC, I had a really, really good time today, buddy. It's good to see you, man. I miss you so much. I went on a run this morning with my brother-in-law, and I was just like, man, this is not like running with Gregg in the mornings on Thursdays. And these mountain slopes out here absolutely killed me, bro. So it's just good to see your face, my friend.
Likewise, brother. We'll get through it together, buddy. We'll get through it together. Luckily, we have even more FaceTime and meeting time and show time next week. So a special invitation to all of our clients for the Monday call. You have already received an email, or you will be receiving it very soon from your portfolio manager here at JWB with a special link. That's just for turnkey clients. And the reason that we do that is because we want to give you the opportunity to ask whatever questions you may have. There's usually hundreds of clients that show up for the call. And this is going to be time for you to be able to ask any questions that you have. So I hope to see you. That is Monday at 12:30 Eastern. And again, there's an email that's sent out to you with all the details to sign up. And then for everybody who's not yet a client, or for all the clients that want to show up again on Tuesday, we would love to have you for the show. We are going to, of course, bring you everything that we can to show you about the Jacksonville real estate market and what's going on at JWB over the last quarter. And a lot of future, we'll talk about what we see in the future as well. So those calls we do every quarter, and they're pretty fun. So we hope to see you guys, and we'll see you in the group. Until then, thank you guys for making this special.